Well, let's get more with Dr. Stephen Nash from FIIG Securities. Dr. Nash, that story continues to pose fresh questions, principally, the broader implications for the rest of that funding impost that the Big Four are facing out this year, and also why foreign investors would pay less in this market than they could be getting for issuance that's taking place in Europe right now.
Look, what the issue really is that the covered bond sets the base for other interest rate spreads in the market. So if the covered bond is around 175, their unsecured debt should trade above that. Now, we've seen the unsecured debt levels for the 5-year rise from 160 to 185, so that's like a 25-point tightening or increase in rates. Given current relativities, that should probably go up to about 210 basis points. So that would be like a 50-point increase in funding for the banks, which is a substantial increase. I think that's the really important thing that people are focusing on right now, and there's a lot of adjustment going on in the wholesale markets. It will affect corporate funding spreads as well over time as relative value is pursued by institutional investors. So it's quite a significant issue in the Australian markets here.
Do you see the situation changing on any one particular factor, or this is going to perhaps be the new paradigm, as they might say?
Look, at this stage, it really depends what happens with the basis swap and the cost of bringing those funds back into the local market. At the moment, that basis swap has been trending outwards, forcing the banks to go earlier than they probably would have liked to go. And given the trend, it appears that the basis swap is heading further out, so that would mean there might be an increased focus on the domestic market. I'd imagine that we're going to go a little bit wider in these spreads, the 5-year unsecured going towards 210. At that level, I imagine there'll be quite significant interest by institutional investors. So that should be the target, and I imagine that will stabilise at that level.
Dr. Nash, do you know why the NAB is planning a sterling-denominated bond? Is this really to exercise an option on what's required for its UK operations, the future funding burden there, or it will be repatriating?
Look, I think it's just another a market that needs, the banks need diversity of funding from different markets. The main issuance for the covered bond should be in the euro market, but again, the basis swap's expensive there. Same thing with the sterling, but the banks are trying to increase the diversity of funding, so that means different products, which means covered bonds, but it also means funding in different markets, and sterling is, I suppose, just viewed as another way of diversifying in their investor base.
Let's talk about the broader story today, the main risk to employment domestically, and the 20-day range that bonds are finding themselves in, telling you what ahead of these numbers?
Well, we've had a little bit of a rise in bond yields as a result of equity market buoyancy the last few days, so we're down towards the lower end of the trading range. So I suppose the risk for the market here is that the number is a little bit weaker than expected, employment a little bit weaker, and the market rallies from here. However, the US market, in terms of the bond market, has been holding in very well, given the recent rise in equities. I think the market in the US is focusing on the end of the month with expectations that tightenings will be pushed out towards 2014-15, so the market will hold in until that announcement, I imagine.
Yeah, any parallels with what you see in the US with tightening?
Look, I think what happened with QE2 is the market got quite bulled up, rallied quite a bit into it, and after the announcement sold off quite a bit. So I think that's what could happen here in terms of or the bond market into the announcement at the end of the month by the Fed. After that, I think all bets are off, and we could get a little bit of a rise in yields.
Dr. Nash, okay, numbers are going to be keenly watched when they break on those jobs figures. We will talk to you soon. Thank you so much.
Okay, thanks very much.